what color shorts can I wear with that the next time I'm on? Oh, never mind. How are you?
Excellent. It's
Good.
great.
Good.
It's good.
Good.
It's good
So
to
am
see you
I.
again. I love the background. I love the display there. It's super. Love it.
New smart board called a Vibe. You see just a second, I'm talking to my assistant. You see the shadow of the door on the bottom. Yeah, close it. It's a computer. It's a smart board. I can write on it. I can show my PowerPoints. I can do anything. I can make after we do a diagram. If I'm doing some training, I can push a button and email it to all the people that are listening.
That's excellent. That's what Grant uses, right?
I don't.
I think Grant Cardone uses.
But if he uses it, he's a step ahead of me. I have it. and I've done this. So on my desktop is broadcasting a PowerPoint slide, and I'm using it as my background. But I'm talking to you on my Surface. It's an awful lot for a 72-year-old man to figure out, you know.
Yeah. Well, you're a sharp guy, though. You're a sharp guy.
Absolutely. And I'll be a sharp dresser too with my "Make It Rain" T-shirt.
Yes. You have to tell everyone about it.
So, do we have any idea what we're talking about today?
Yes, today
okay.
We're going to talk about deal syndication. We actually have some new faces in the group right now, and I think the reason why everybody joined us today is just to get a feel for what deal syndication is, why it's important, how do you get a rough idea of how you do it, how you set it up. And that's why I'll
be interested in hearing that.
well, I hope you don't want me to explain it because you literally wrote a book on it.
We'll explain it together.
There we go. I mean, so here's the thing. Gene Trowbridge is one of the, if not the leaders in this space when it comes to deal syndication. So bar none. There are other guys out there that do it, of course. You all know the usual suspects, but whenever those people are generating the documents and going through their processes, they are usually referring to the material that Gene put together to build their own SEC document. So
yes, plagiarism is a form of compliment, right?
And they actually do that too, by the way. They do actually plagiarize that. That's a whole other discussion.
I know that, but that's okay. I probably plagiarized 30 years ago when I started too. So there you go.
There you go. But in something like this, though, I'll tell you, before I met with Gene and before I got connected with him, I was using a different attorney, different SEC attorney, and it was not good. It was not a very good experience at all. And I can personally attest to Gene's capabilities and his know-how. So, and this is not a paid endorsement or anything else like that. He's the real deal.
It is 100%. Paid. I'm getting the shirt. Thank you very much. And when I was a syndicator, Augustino, for all those years, I went through a whole slew of SEC attorneys myself to find the ones that I could work with. I think everyone's pretty good. Everyone's smart, and the rules are the rules. You can't stray too much from the rules, but practical knowledge is what's lacking.
Yeah.
And I say that patting myself on the back after being a syndicator for such a long time and doing as many deals as I did. I do have practical knowledge. I know what the complaints are from the investors. I know what happens when properties get foreclosed. I know all that stuff. So that helps.
Yeah. I mean, that's a key thing right there, is that aside from having the experience of doing, billions of dollars worth of deals in terms of syndication, he's actually done them himself. And I'm not a steal his thunder. I'll let him explain all that, because you definitely want to have someone on your team that knows what they're doing. This whole business, I'll tell you right now, for those of you guys that may not have done a deal before, this whole business relies on teamwork. There's not one single person that does the whole thing from beginning to end. They have a team. They have their their law firm, that, the regular real estate attorney, they have their SEC attorney, they have their accountant, they have their inspectors, their contractors, the whole 9 yards. And this role specifically, when you can say that you have an experienced syndicator that's done deals and they can walk you through the pitfalls of what happens if, ahead of that actually happening, it's priceless. Believe me.
That's all good. Now,
yeah.
We could make this a very short conversation if your people want to know about a syndication and why you get into it with this comment. You get into syndication when you don't have enough money to buy all the real estate you want to own yourself.
That's right.
Right?
That's right. Yeah.
So that's how I got into it. I was back, it's been a while, I was back in Minnesota, and I was buying some single family houses for investment property, and that got a little tiring. So I thought, well, I'll buy a little bigger property. Maybe we'll take 10 of those single family houses and stack them on top of each other and call it an apartment building. And I only have to fix one roof and go to one place. And by God, I didn't have the money to do it by myself. Yep. So I got on the phone and I called some guys I went to college with, and the four of us got together and we did our first deal. And I didn't even know how to spell syndication at that time. I just knew that we needed to pool our money, and we needed a partnership agreement to put us all together. And one of the guys who had been my roommate was an attorney. But he didn't know anything about partnerships, but he learned. And so he drafted the first partnership agreement I ever signed. And I became the manager, and I raised the rest of the money. And about 3 years later, I thought that was the industry I wanted to be in. Not just a passive investor. I wanted to be a deal sponsor, the lead guy, and help people seize on opportunities that were out there that they wouldn't be able to seize on themselves. Because in those days, we were all young. We had a house and we had some life insurance, but we were working like crazy, raising our kids and doing our job, and our wives were working and all those things. And no one really had the time, the knowledge, or the energy to be a sole owner of a 10-unit apartment building. But I did, because I was in the brokerage business. So I was in the commercial real estate brokerage business. So it just fit. And when I moved to California, Augustino, I stopped being in the brokerage business and just went full-time in the syndication business. And for about 15 years, that's all I did. And primarily, I built storage facilities. I think we built 28 self-storage facilities. I know a lot about pouring concrete. And you pour concrete, and you put up metal dividers and a metal roof, and you paint an orange, and you might get to sell some of them to public storage. So it was an easy job. Yeah,
and those are great businesses too, by the way. The self-storage business.
Well, it's a specialist. Some people are out there. I know you do a lot of multifamily, almost exclusively, and I hated that. I got out of the multifamily business when I moved to California because I couldn't take the management. And then I made the dumbest decision. I went into a mobile home park, and it was a senior mobile home park. And this isn't very polite, but I will tell you the definition of turnover in the senior mobile home park I owned is when the phone rang and they said, we haven't seen Gladys in 3 days. So you go in there, and poor Gladys is in the bathtub dead, I'm being cynical, but that didn't work for me either. So I decided I would go find a piece of real estate. And it's one of the things I teach now is find a piece of real estate that you're comfortable with, and then pick a part of the life cycle of that real estate that you're comfortable with, and then become an expert. And so I found out that if I bought 600 units and there was only one bathroom, and I could have a full-time manager working on it, and no one slept there, and it was pretty easy, that would be a good thing to manage. And then I thought, I really don't want to manage them. So hell, I'll just build them. And there was a market back then for building them, getting them about 40 or 50% absorbed, occupied, and then selling them to the companies who wanted to be longtime holders and investors in storage. So I found a little niche. And that's what I think, if you're going to be a syndicator, you have to go through. I've got a couple steps that someone taught me about the sizzle that maybe we'll talk about when we go a little farther. And it kind of led me to what I did. And it worked for me. Might not work for anyone else.
Right. Now, and the thing is, though, the key thing to understand is that anything could be syndicated pretty much, right? It's like, it could have been multifamily, but you chose to do the self-storage. And I know you did a bunch of other things as well, aside from that, but I mean, pretty much.
Well, I did some office. We bought some stuff at foreclosure sale, a lot of different things, but that's the one I really got down and concentrated on. Right. In our legal practice, Agostino, I've done the dreaded cannabis. We've done solar panels. I've helped people start educational schools. Anything you can think of, really, we've probably done. And because syndication is just raising money from other people for some business purpose.
Excellent.
And it doesn't make any difference what the asset is. The securities rules are the same. The security rule doesn't care what the asset is. The security rules are how you raise money from investors and how do you protect investors. That's what that is. It doesn't have much to do with the asset.
Yeah. So, well, let's get into that. I think there might be some people that are not that familiar with what syndication actually is. So we should go ahead and maybe describe what it is. And by all means, guys, as you guys have questions while Gene is explaining, go ahead and type it in the chat box, and that way we can address them as we go. And I would love to hear from you. So any questions, please, by all means, throw them out there. We'd love to get them answered for you. So maybe Gene, do you want to maybe help some of the people that are not that familiar with what syndication is to give an explanation about it?
Well, sure. Let me give you an example of syndication. You go to the movies. You know, when it was, we were going to movies, right? You go to the movies and you sit down, and across the screen it says, you know, United Artists, MGM Grand, Universal. 3 movie studios got together to do this movie. They combined their monetary assets and their experience, and they created something that was a business. Okay, the movie's a business. Well, that's just a syndication. 2 or more people pooling their money and their expertise to accomplish some business event. Now, you could actually have a syndication that isn't business. GoFundMe is a syndication. You know, I've been cooped up too long. I want to go somewhere on vacation, but I need someone to pitch in some money. So I could start a GoFundMe page. That's a syndication, everyone pooling their money so I can do something. So really the syndication isn't so magical. It's just finding other people to invest with you. But when it happens to be a business and the people are investing with an expectation of profit, that jumps you into the securities world. Okay. And so I get a lot of calls, Augustino. People say, hey, Gene, I want to put together a deal, but I don't want it to be a syndication. That's probably not the right statement. They do want to make it a syndication because they want to raise money from 5, 10, 15 people to do whatever they want to do. What they really are saying is they don't want to make it a security because they don't understand the security rules, and they don't want to get involved in that because they think that could be very expensive and frightening and time consuming and mysterious and all that. So well, isn't that your experience, Augustino?
Well, it's exactly it. I mean, I remember when I first heard about it years ago, the fact that the SEC's involved is now you're talking the big leagues. Oh my God, that sounds scary, right? And really, I mean, and it can be scary if you don't know what you're doing and you screw it up in a big way. Yes, then it gets really scary. But that's exactly it.
What most of our people do isn't scary. You know, our At our firm, I've been I've been alone in the business for a long time, but really for the last 12 years, I've been in one form of a partnership or another. And we've probably done 850, 900 deals for about a $5 billion raise. But on the median we're raising about $2.5 million a time with 10 or 15 investors. And that's about what it is nationally. The latest figures from the SEC are that Regulation D, everyone hear that, Regulation D is where Agostino and I work for private placements, did about $1.6 trillion in money raising over the last 12 months that they studied that. 1.6 trillion. That's more than Wall Street raised for new money in the same period of time. And so these private placements that are doing, what do? They finance business. They finance small business. Small business is what defined, Augustino, 500 employees or less. And where do these small businesses get their money to start and expand? They don't go to Wall Street and get it. They go to private investors, private placements, using part of the securities law called Regulation D. And all the figures in Regulation D would echo what my company does. The average size of a deal is maybe 15 investors, $2 to $3 million. Now, Agostino, you've done much bigger deals than that, and you've done smaller deals than that. It just depends upon what you're working on. I've got a client, Agostino. I know I've told you about this client who I'm working on the 108th offering with them since 2014. Okay.
Wow.
And they only raise money from accredited investors, which you can talk about. Now their funds are closed. If you haven't invested with them in the past, they don't want any new investors. And they raise between 3 and 5 million every single time. They don't advertise. And they just do deal after deal after deal, but they found a niche and their investors are making a lot of money. And it's pretty much cookie cutter now that we know what the rules are and how they can do it. So very interesting. And then I've got a lot of people, Augustino, and you know some of them, who do their first deal and say, oh, I'm not doing this anymore. And you know why they do that is because no one realizes until you've done it, Agostino, that the syndication world is really about people. Yeah. It's not about property. I'm out here in California. Most of the deals we do are somewhere else. So there's long distance property management. But what does the syndicator deal with? The syndicator deals with the 15 or 20 people in the deal whose lives go on and change over a 4 or 5 year period. So that's what I learned. And that's what actually took me out of the business. The care and maintenance of partners got to be overwhelming.
Yeah. And I think that's probably one of the things that people, and I was actually talking to one of the people that was, that's listening in right now, Zachary. It could be for anybody starting out, as a general partner, there's a whole lot of responsibility aside from the fiduciary responsibility. There's the investor management side of things, which could be could be overwhelming if you don't have a back office to help you with it. And but as a limited partner, you're still in the deal. You get all the benefits, just without the headaches.
Yeah.
Right.
Do you guys use a back office company? Do you use IMS?
Kenny, well, basically all my deals, I just funnel them all through Kenny. So he's got
okay. Yeah.
IMS,
And does Kenny use IMS?
I believe so. Yeah. Yeah.
Okay. So that's a big change since when I left the business. When I was in the business, I had to do it all by myself. There were no back office companies that were for hire to help you. And in my, I always call it my height of insanity. One year I sent out 1,686 K1s. I spent 3 months licking stamps and envelopes, and then I was in a position, and I represented about 850 investors. And I was in a position that I really had to grow. I had to do bigger deals and more deals, and there was no back office help. So it would have been, bigger office space, more employees, more overhead. And I just thought, I've always wanted to go to law school. This would be the perfect time. So when I was 45, I shut down my money raising. I still had 6 or 7 years of property management and asset management ahead of me, and went to law school. The rest is history, as they say.
That's right. That's right. Actually, there's a question here from Noah. And it's interesting because, Kenny was in town the other day and something like this came up. How does the SEC monitor your database with regard to the SEC qualifying investor relationships?
They don't modify your database. If you're working under Regulation D, which is the private placement set of rules, the SEC has very little touch to you. When your final documents are drafted, we send a form to the SEC, and we're doing Regulation D. So the form is called Form D, and we send it to the SEC, and it's an information gathering form. And it talks about who you are, where you're located, how much are you going to raise, and maybe in what states are you going to raise money. And that's about it. There's no more reporting. You do have to tell a state. Let's say I raise money in Ohio. I have to tell Ohio that I've raised money in Ohio from some investors, so that if an Ohio investor complains in Ohio, Ohio knows how to get a hold of me. Okay. But if you keep it to Reg D, there's really no constant contact with you. Now, if that question is going to, how does the SEC know if you've advertised or not for your investors? That might be a different question, which maybe we can get to later. But that's one of the beauties of the private placement world. There's no audits, there's no annual reports, there's nothing.
Right. But I think but a key element though is on the investor side, just like I said, the SEC doesn't monitor, but at the same time too, it's up to you if you are going to syndicate and put together a deal. You need to make sure that you're vetting out that investor. Are they truly accredited? Are they sophisticated, or whatever bucket they're in? Because the last thing you want to do is take the last $100,000 or $50,000 from that old grandmother who's got no money at all. All she has is $50K and that's it. And then if she doesn't know what she's doing, and but you take her money, you put it into a deal, and for whatever reason, even if the deal is going great, she calls the news and says, "Oh my God, look at what happened to me." And next thing you know, not only is it you're going to have a bad rap, the SEC's calling you, and you don't want to deal with that.
Absolutely not. Absolutely not. So,
but maybe we can get into some of that, Gene.
Sure, I'll go wherever you want.
Yeah, let's talk a little bit about what an accredited investor, what a sophisticated investor is, and maybe even to provide some tips on how you recognize when you're talking to some of these people. Like, what are some of the things that you used to do or still do when you're speaking to some of these folks?
Okay. I need to apologize. If you're hearing something, something from this board behind me. Yeah. I have no idea what it is. Did you hear that?
Yeah, I heard it. That's fine.
I think what it is, I think on my desktop, which is projecting the picture over here, I forgot to turn off my emails.
Oh, okay.
So I'm getting a blurb when my email comes through. I hope that's not too disturbing. I could
no, it's
away
fine.
And fix that.
I didn't even notice it.
Okay, good. Well, there you are. So, Regulation D. Let's even take one step back farther. In the 1930s, as a response to the market crash and all the devastating things that happened in 1929, the government thought that people should be protected when they invest. It makes sense because people were losing money. And the government identified two issues. One issue was the people weren't getting the right documents or any documents. They weren't being told everything they needed to be told. And the other thing was the people that were selling the investments weren't vetted at all. They just were selling investments. So they really created two rules. One relates to the documents and what is being sold. And we work under that rule today. And the basic premise of that rule is you need full disclosure. So whatever the 1,000 pages are, they're always talking about, hey, did you give the investor all the material facts before they invested so they could make an informed decision? And so you ask, well, what the hell's a material fact? Well, a material fact is kind of whatever you think an investor would think it would be material in helping them make up their mind if they're going to invest or not. So you're required to do that. Then the other law that came out is, hey, we're going to have to regulate who is out selling these investments. And that law created the ability for the SEC to issue licenses, registered reps, securities brokers, registered investment advisors. Let's vet these people, let's give them licenses, and let's control what they do in their selling process. All right. So the one we work under most of the time is the one where we're dealing with disclosure. Because they put an exception in the rule about being licensed. And it's like those of you who know the real estate business, you can sell your own real estate without a real estate license for sale by owner. Okay. And they put the same type of clause in the securities law. And they said, well, if Gene is going to put together his own offering and go out and sell his own offering, he won't have to be licensed. They don't call it the for sale by owner, they call it the issuer exemption. So the rule on being licensed is pretty mammoth, but there's an exemption. If you're the issuer, you don't need to be licensed. So almost no one who's listening to you today will have to worry about being licensed. The trap there is if people are listening to you today go out and hire other people to sell their securities for them, we better make sure that those people either are licensed or qualify as issuers. And that's a different story for a different day. But what we need to do is deal with the disclosure. So the next thing that the securities law has decided to do, Augustino, is to say, you know, there's a whole bunch of investors out there who are rich and smart, and they don't need our protection. We're going to have plenty to do to protect the people who aren't rich and smart, which is the vast majority of the population. So they created Regulation D, the private placement rule, which was primarily generated for offerings to people who were rich and smart. And they called those people accredited investors. And they carved out a whole bunch of the industry and said, you know, you sponsors, you can go out and raise money from these rich and smart people. We're not going to regulate you. They got to be rich and smart because of their education, their knowledge, and they should be smart enough to decide for themselves if this is a good deal, as long as you give them the disclosure that you're responsible for. If you give them all the facts, they should be able to take care of making the decision themselves. So you guys deal with accredited investors all the time, right, Augustino?
That's right. Yeah.
And accredited investors sometimes aren't the smartest people in the world, but they're rich. So you don't need to hold their hands. Now that was the rule for a long time, and I haven't defined it yet because for a long time it never went into the securities world as a definition of rich and smart. Never. It was left to the syndicator to ask questions of investors to determine if they were rich and smart and didn't need protection. So that went a long way. And while I was in the business, early on, actually, when I was in the business in 1981, the SEC modified Regulation D and put a couple rules in Regulation D. And one rule is Rule 501. 501 defines what an accredited investor is. And the rules never really changed. They said, okay, we're going to remember this, Augustino, this is 1981. You weren't syndicating then, right?
No. I was 10 years old.
Yeah. So you had hair. You had hair, right? And mine wasn't gray. So what the hell? So in 1981, they said, okay, this is what we're going to say an accredited investor is. It's a person who has a net worth of $1 million or more, either an individual or a family. And then we're also going to say, because maybe, it was a lot of money in 1981, maybe they don't have a net worth, but they do have an annual income. And so they said, if you're filing an individual tax return, $200,000 would make you rich. And if you're filing a tax return married, filing jointly, $300,000 would make you rich. So they defined accredited investors just with dollars and cents. There was really no smart about it. But there was another rule that said if you were smart enough to have a registered investment advisor making the decisions for you and looking at all your investments, you would be classified as accredited regardless. And that really applied to people like widows and widowers who are now alone and all the money's in some irrevocable trust and they just get a stipend. But they hire professionals to manage their money. So we don't run into that very much, at least in the past we haven't. So, that rule went on forever and that's still the rule today. And what's interesting about it is in 1981, $1 million of net worth meant something.
Oh yeah, that was a lot of money back then, for sure.
A lot of money. And oh gosh, in maybe 2010, 11, I'm not exactly sure when Dodd-Frank came out. I don't remember. But Dodd-Frank looked at that and said, people were losing money in 2008, 9, and 10. People lost a lot of money in the market. And Dodd-Frank came out and said, we've got people on Social Security who bought a $30,000 house in the California coast that's now worth $3 million. And they're accredited and they don't need our protection. So Dodd-Frank came along and changed the definition of accredited investor to eliminate the equity in your primary residence. That made a big deal. That cut the number of accredited investors in the country in half. But that really only applied to certain parts in the country because there are only that many places in the country where houses were worth $1 million and people own them free and clear. So now the definition is still the million, it's still the 200, the 300, but you can't count your house. One of the things that, Augustino, I've seen in the business is we have a couple clients who syndicate and they only take money from doctors. And with the change in the medical practice, I don't think a lot of doctors know what their practices are worth on their balance sheet. So if you take the practice off of the balance sheet and the house off of the balance sheet, you have to go toward income. So these sponsors that we have only look at the doctor's annual income. That's the only way they look at qualifying an investor as being accredited, 200 or 300,000. Now, that whole definition is what we're working on today. And Augustino, you and I know that there's some proposals out there for public comment where the SEC is saying, you know, we need to expand the ability of capital raising. We need to make sure people can raise more capital to put more people to work. And maybe we need to expand the definition of an accredited investor and do other things. So the last explanation I heard on this, and just remember, it's $1 million, not counting your house, and 200,000 if you're single, and or $1 million or 200. So I told the story of a lady who works on Wall Street analyzing financials for a REIT, a publicly traded real estate investment trust. This lady had $890,000 in the bank, single, and made $190,000 a year, and could not invest in the offerings of the REIT that she was analyzing because she didn't meet the definition of accredited. And there are registered reps. There are people out there with their securities licenses or financial planners and whatever, and are educated and tell people what to do, advise people what to do. But maybe at the stage in their career, they haven't reached the definition of accredited yet. Well, shouldn't those people be able to invest? So there are some proposals out there that might expand the definition of accredited. But right now, the last statistic I saw, Augustino, was there, about 16% of the households in the United States are accredited. Well, that's a lot. That's still a lot of money.
Yeah,
that's a lot of money. So why did we spend all that time talking about accredited investors? Back to Regulation D, right? We said Regulation D was created to allow people to raise money from those who are rich and smart and don't need protection. Well, in 81, they gave you a definition of accredited investors, and for the first time, they made a change which was designed to allow more people to invest in these small local deals. And they said, you know, if you don't advertise, you can take 35 investors in your deal who are not accredited. You know them. You have a relationship with them. And if they're smart enough to understand what's going on, and we call that sophisticated, you can take 35 of those people into your deal, which opened up money raising. I mean, it's really terrific. Opened up money raising. You can have as many accredited investors as you want, but in addition, you can have 35 of these sophisticated investors. But you couldn't advertise. It was still a real private placement. And Augustino, when you do deals, you take both accredited and sophisticated investors, don't you?
Correct. Yep. Sure do.
Because sophisticated, I mean, you might have $400,000 in your IRA after being on a couple jobs. You might not be accredited, but you're looking for a place to put your money to work. Okay. So you're sophisticated and you can invest in those deals. That's good. In fact, a lot of the first-time syndicators raise a lot of money from people that they know that are their peers, and they're not all accredited, and they all want to invest. So that's pretty exciting. So anyhow, Reg D said you could have these sophisticated investors. Well, let's fast forward to 2012. 2012, we're coming out of a bad economic time, and the issue was more jobs. We need more jobs. So Congress passed the aptly named Jobs Act, and it was all about promoting more jobs. How do we get more jobs in the economy so small business can expand and we can hire more people? Well, one of the things the Jobs Act said is we've been restricting all these private placements to sponsors who can't advertise. They can only take investors that they know, and investors are out there can only invest in deals where they know the sponsor. Let's expand that. Let's let the sponsors advertise to those rich and smart people who can make their own decisions. And let's make sure they make the full disclosure, they advertise, and then the rich and smart people can invest. Let's think about us today. Let's say you and I are doing a deal together. And before the Jobs Act came, Augustino, the only people we could talk to were people who we knew, right? So we would have known a bunch of accredited investors, but not 16% of the households in the United States. We would have known some. And then of all those accredited investors out there, there was just a very small number of them who knew us. So what Congress said is, Gene and Augustino need to tell their story to more people. And more people need to hear about what Gene and Augustino are doing. So let's let Gene and Augustino advertise to accredited investors. And I said that incorrectly. Let's let them advertise, but make sure that they only take accredited investors in their deal. Right. That's the point. Did the sponsor take steps to be reasonably assured that the investor who he attracted through advertisement, who he doesn't know, is accredited, and there's some third-party verification that goes on there. So that was pretty exciting, opening up the marketplace to you and I going out and finding new accredited investors, and then new accredited investors finding us. And what do we have now, Augustino? We have these crowdfunding platforms.
Yep.
That you can sign up for. If you're an accredited investor, you can sign up on these platforms, and it's like a multiple listing service of offerings. If you and I had an offering and we could get it on one of the platforms, then the accredited investors come home at night, take off the shoes, have a glass of wine, and go to their computer and look at 20 or 30 offerings on this platform and decide where they want to invest their $50,000, which is a typical investment amount. And that's pretty exciting for the industry.
Yeah, absolutely. That's the whole crowdfunding initiative. That's what all that is. It's just amazing. It really opened up the floodgates to allow many people to invest their money into deals. And it's funny that some of those platforms, like let's see, what is that one?
CrowdStreet.
Yeah. That's
Real
one.
Crowd. Yeah, they're all people who are listening. If they want to
Fundrise,
see what it's like, go to crowdstreet.com. But you know what's important, Augustine, or not what's important, but what SEC has learned is that we have Regulation D, right? And what we just did with the Jobs Act is we've broken into two parts. One part is where you don't advertise, you take your sophisticated investors and your accredited investors, people you know, and then the other part is where you advertise and go after people you don't know. 96% of the money that was raised during the last 12 months that they studied was raised over here from sponsors who know their investors and don't take advantage of advertising. Amazing.
Yeah, it's awesome.
This side hasn't really taken off the way they thought it would be. There's signs that it's growing, but it really hasn't taken off. And I told you about this one client that we've done 108 deals. They don't advertise. They don't take new investors. They don't need anything like that. They're comfortable with who their investors are. And that pretty much tells the story of guys like you and Kenny and other people who've done plenty of deals. You've got plenty of investors.
Yeah. Well,
you don't need to go out and take the risk of finding someone who isn't going to fit in. You
That's
know?
right. And that's probably one of the answers to this question that James asked. Why is it necessary to have a prior relationship with an investor before presenting an investment opportunity to them? I mean, part of it is you have to vet them out. You have to understand and know if they are accredited or sophisticated. Like, are they truly representing that they have the money, they have the knowledge, they know what they're getting into. But long term, you're going to be pooling from the same group of investors conceivably. I mean, just like Gene just said, yeah, there's plenty of deals that I've done with even with Kenny. It's like we just pull money from the same people, and the same people are always throwing down. Yeah,
I have another answer for that. Every security has to be registered with the SEC unless it's exempt. Regulation D is a place for exempt offerings. So good, if you follow the rules in Regulation D, you're exempt. Wonderful. 506B says you don't advertise. 506C says you do. So you have to follow the rules. So how do you defend yourself when the SEC comes to you in your 506B offering and says, you know, I think you advertise for that investor? And what's the investor going to say? The investor is going to say, hey, the deal went bad. I never knew Augustino. He sent me a postcard and I invested with him. What's Augustino's defense? I had a pre-existing substantive relation with that investor. Prove it. Okay? So pre-existing and substantive is a defense when you're charged with advertising. And if you're going to be advertising, then you can only take accredited investors, and you have to have some third-party verification on every one to be reasonably assured that they're accredited. And if you break the rules, you don't have an exempt security. Therefore, you'll be found to have sold a security that you didn't register, and that'll put you in a whole world of hurt.
Oh, yeah. Yeah. And that's why it's like having good systems in place, having a good CRM, having a good back-end management system so you can track the communication with some of your investors that you've spoken to, having a chain of emails going back as far as you possibly can. Absolutely. Yeah, it's very key.
That's what I tell everyone. I told you that, you know, you need to have a record-keeping system to know when you met that investor. That would be the first thing. And secondly, a record-keeping system that says, okay, when I met that investor, I had this offering on the street and they didn't buy it. I met the investor on June 25th. The investor did invest, but what they invested in, I wasn't offering on June 25th. So there's your protection right there. There's your defense.
That's right. That's right. Now, Zachary had a question here. Would it be more difficult to invest in good deals as a sophisticated investor rather than an accredited investor?
No, most of the deals that are out there will accept sophisticated investors. More deals are out there for that than only accredited. So if you are sophisticated, that means that you're knowledgeable enough that you can read the offering documents. You can ask questions from the sponsor. You can talk to your CPA and your attorney. That's where all the deals are, Augustino. All the deals are in the 506B. We will accept accredited investors world. That's where they will accept sophisticated investors. That's where they all are.
Yeah. Yeah. It's usually those people that are hungry to get into a deal, to cut their teeth on a good deal, get that experience, and get those units under their belt, right? It certainly helps in getting that experience like that as well. Absolutely. Absolutely.
More questions? Let's see if there's more questions here.
Let's see. Oh, here's a good one from Zachary. Any suggestions on how to vet a syndicator?
Boy, that's a great question. I'll give you the 4 questions, and Augustine, you've heard this. I'll give you the 4 questions you should ask. And interestingly enough, your question, Zach asked a question about betting the syndicator, not the deal. Okay.
Yeah.
And I'm talking about the syndicator. Number one, Augustino, I kind of like your deal. Your minimum investment is $50,000. If I give you my $50,000, what happens if something happens to you? There's the killer of a question. If Augustino says, well, I'm the manager and I'm all alone in this, don't invest with him. Even if he's formed an LLC and he's a single member LLC, my best legal advice is don't do that. We could have a whole session on 6 or 7 situations I know where something happened to an individual syndicator in the middle of the deal, which really adds risk to the investors. So we always tell, in fact, I won't do a deal. I won't represent a client as an individual member. And people every once in a while call me and want me to look at their offering documents, which I don't do. But I will tell them these 4 questions. Number one, if you give your money to that syndicator, what happens if something happens to him? Is there a plan? Is there continuity? Okay. Number 2, have you done this before, Augustino? Okay.
Yeah, I've done this a couple times. Yeah.
Everyone, I had to answer that question. No. Augustino, in your first deal, you had to answer that question. No.
I did.
But you have to be ready for that question. No, Augustino, I haven't done this before, but I have this education. I've owned 4 apartment buildings on my own and blah, 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 blah. I'm ready to go. And my teammate, my partner in this has done this. Okay. What's your answer going to be? And if the answer just simply is no, and I have no experience and I have no teammate, well, my legal advice is don't invest there. Okay. So it's continuity. Have you done it before? Next question is, Augustino, this looks like a pretty good deal. Is it good enough for you to invest your own money in it? And you guys invest in every deal you do.
Yeah.
Okay.
We do.
Not every syndicator has to do that. And I've come up with a great answer. Well, Augustino, that's a good question. You're asking me if I'm going to invest in this deal. I'm not going to invest any money in this deal, but I'm signing on the $3 million loan that allows us to buy the property.
That's right.
Okay.
That's right.
That's a pretty good commitment, isn't it? Whether it's recourse or not, I don't care.
And I've got that question before too. They say, well, do you have any skin in the game? I go, well, I am signing for the loan after all. Yeah,
absolutely.
So that's kind of like a little bit of skin in the game on in a $10 million deal. Yeah. It's yeah, it's a little skin in the game. Yeah.
And then the last question you'd ask the syndicator is, if something happens in my life, Augustino, where I need liquidity, how are you going to handle that? And Augustino is going to come back to you and say, well, we have a professionally drafted set of documents. We have an operating agreement that has, in my agreement, it's Article 11 that talks about liquidity. Let's go through that. Let's talk about that. Do you need to ask anyone what that means other than me? Let's talk about it. And so those are the real questions. Now, inside of each of those questions, I guess there's sub-questions. Well, Augustino says, yes, I have a partner who's so-and-so. Well, who's that? What's their track record? And, all this stuff has to be disclosed. These are all material facts. Every one of those questions is a question that the answer to that question would make a difference in whether an investor invests or not. So they're all material facts that have to be disclosed before you invest. And if you go to track record, you can ask the sponsor what the track record is. How are the deals performing? Do you have any deals? I wouldn't ask them how the deal's performing, because if everything's performing well, who cares? Right. I'd ask them, what happened in the last deal that you had trouble on? How did you deal with that? Okay. When I was a syndicator, I had a deal where we lost 2 properties in foreclosure. Okay. It was about a 2-year process to get to foreclosure, and there are a lot of steps, and my investors were fully informed. I never got sued. It was nothing like that. It was just that the Tax Reform Act of '86 came along, and the real estate market crashed, and there was no permanent financing for self-storage. And we had 2 self-storage units sitting out there on construction loans. And the construction lender wasn't in a place to make a permanent loan, and no one else was making permanent loans. And we just got caught in the lending crisis. Okay, so that happens. Did I do deals after that? Sure. Okay, a lot depended upon how I handled that and how I communicated with everyone.
That's
you
the
know,
key right there.
life
Yeah.
goes on, Augustino. Sometimes, and I know you won't believe this, sometimes, Augustino, you can get 10 days before a deal closes and the bank changes their mind.
Yeah. Yeah. I have an idea about how that works. Sure. Yeah.
And so that's the type of question I'd ask, when you had a deal that went bad, what did you do? I've
Right.
got a client right now that came to me, and we talked about what does the document say about capital calls. And we went through the whole discussion. And what they decided to do is they decided to do a manager advance instead of doing a capital call. I think that's spectacular for future. Well, we had a deal and we had a little problem, and we advanced the money, and I think we worked it out. Great. Wonderful.
Yeah. That's smart. That's smart. Yeah. Having those contingencies in place, but I think more importantly, how you handle and how you vet that syndicator in that way. You want to know how they're going to handle the communication. That's the key, right? I mean, there's other syndicators that I know, I'm sure Gene knows them too, personally. They just had a tough time in this business. They quit altogether. You never see them again. They're gone. They're gone. I mean, this business is not easy. It's not, no one will ever say, oh yeah, it's simple. It's cake. Finding deals is a full-time job. Running them is a full-time job. It is not simple. You have to really love this stuff. You really have to love it, right? It's not just getting rich and making money and everything else like that. There's work. There's work involved here. There's a question here from Noah. Gene, does non-recourse loan bypass that from question 1?
See, even signing on a non-recourse loan is part of question 3. Do you have any skin in the game? Sure.
Yeah.
Because non-recourse loans still have carve-outs, and there's things that's going on, and it precludes the sponsor from doing other things because they're on this loan. And so when they state their financial balance sheet, they have to tell people. So it's still skin in the game.
Yeah, that's right. And then Pavlo asked a question too, where to find good syndicators in different markets and states? Is there a go-to site of any sorts?
Yes.
I don't know of any. There is a site?
Yes.
I don't know of any.
Well, you can go to it's called Edgar, EDGAR.
Edgar.gov.
Edgar
Yeah, sure.
is a site within the SEC where all of the Form Ds are recorded. So you can go and you can find information about syndicators. Now, some of the information is a little hidden. How do you get to them? Syndicators who can advertise are easy to find on Google. Syndicators who can't advertise, a little harder to find on Google.
Yeah, but there is another way too, is that, get to know them via their material they put out there. I mean, we put out stuff on our podcast, we put out education stuff, and then you just get to know them. And every syndicator has a business plan, right? Every single one of them. Like our business plan, my business plan is about just focusing on one area. Like I focus on Cleveland, Akron. That's it. I don't go anywhere else. I'm focused on Cleveland and Akron, even more Cleveland than anything else. Why do I do that? Is because I built my whole team around these areas that are very close in proximity. They're only 40 minutes apart, and the infrastructure is there. The team is there. The contractors are there. Everything is there. I know the market, and more importantly, the market knows me. I know all the brokers. I can get the money. I know how to find the lenders that are interested in investing in that area. That's absolutely key when you're assessing another, putting your money into a deal. Whose horse are you betting on, right? Like there's other syndicators that I know, they're buying 100 units in Tennessee. Why? Because everybody's buying 100 units in Tennessee. I don't like that plan. It's very hard to manage 100 units in the middle of nowhere. Or
I don't think Tennessee. I don't think the people in Tennessee are going to like that. You say nowhere. And the reason you're in Cleveland, I know you. The reason you're in Cleveland is because the Rock and Roll Hall of Fame is there, and someday soon they're going to have a professional football team.
That's right. Someday. But that's the thing though too. You got to sign on to their business plan. And if their business plan makes sense, then yeah, you go all in, go in the deal. I think my business plan is very sound. I mean, I was explaining it to a bank today, actually, just this very day. I was saying, this is how we operate. This is why we operate in this fashion. Kenny piped up. He's got 4,000 units. His model is very, very similar, except now he's big enough that he's doing it in these pockets, but the same model. He's putting his bets in one area, targeting that one area, and just does that over and over again.
But when he goes into a new area, he won't do it unless he finds an experienced partner like you.
Yeah,
he would never have come to Ohio without you.
Right. Yeah.
I don't believe that.
No, that's right. That's right. And that is absolutely huge. Absolutely huge. It's I would strongly recommend against those syndicators. And I'm friends with some of these guys too. If they heard me say it, they might hear me because this is going to be on YouTube. Against those guys that are buying 120 units in like Fort Myers, Florida, another 200 units in I don't know, wherever, Arcana, Texarkana, another, like, they're all over the place. Super, super difficult to manage. Very expensive. I don't like that. I don't like that gig. It's scary to me personally. Let's see. So James is asking, would putting your acquisition fee back into the deal be acceptable to investors if you don't have a lot of money to invest?
Yes, absolutely. We even have a clause in the document that says it's possible that the sponsor, in lieu of taking the acquisition fee, will take units on a dollar for dollar basis. Sure.
Yeah, you can certainly do that. I think keep in mind that when you are putting those deals together, though, depending on how much money you have, I mean, as a guy that puts deals together, it's sometimes you only get paid when you make a kill, meaning you're buying a deal, right? And if you're going to go without an acquisition fee for a couple of years, you're not going to have a good time unless you're getting money from somewhere else. Like if you have a full-time job, or maybe you have like some triple net lease or something like that. You have some other means of income that's cooking, so.
Another issue with that is that's still taxable.
Yeah.
Let's say you're going to have $100,000 acquisition fee, and instead of taking the cash, you get $100,000 worth of units. Well, from the beginning to the end of the day, your balance sheet went up $100,000. Your balance sheet only increases if you buy something or you earn something. So that's taxable income. So you have to deal with that carefully. And make a long story short, you put in there that I'm going to take $100,000 of units in Class B units, different than everyone else's. And at the end, everyone else gets paid first, and then I get paid. That makes your units subordinate and makes it so that there's no guarantee they're worth anything. So if they're not worth anything, it's not taxable today. So the properly written document can get you those units and get you a non-taxable income. But Augustino's point is well taken. You've spent a lot of time getting the deal together. You provided an opportunity for all your investors. I think that's something that you should be paid for.
Yeah. And that's the thing I was mentioning to Zachary earlier, is that and his question was to me, this is before Gene jumped on, like if I put down $50,000 or $100,000, would you educate me on the entire time, step by step, every single phone call? Or, I mean, I'm embellishing a little bit, but just like you said, you're whenever you're putting a deal together, any of you guys on this call right now, or anybody's watching on YouTube down the road, you are working very, very diligently to put these deals together. You're spending a lot of time working with the brokers, working with Gene, for instance. I'm drafting all the documents and making sure that you're investing in a good solid deal, and then presenting it as an opportunity. Yes, absolutely. You should be definitely getting paid for that. It's something. I mean, maybe when you're first starting out, you're not taking a 5% acquisition fee, you're in your 3% acquisition fee, but take something, get paid even a little bit for your work. I think that's important. I think that's important. Bill's asking a question here. Wall Street Journal had an article 10 days ago, non-buying single family homes and then selling 10 or 20 in a package to investors in California at 100 times the rental income. Could you comment on this? Okay. So I think he's referring to those people that'll buy like 10 or 20 packages or rather like, I guess, acquire a bunch of single family homes, package them up, and then sell them off to some buyers out of California at some crazy amount of money just to get them to overpay for stuff, basically. I think is that right, Bill? Is that what you're asking? If you're still on, Bill, maybe still on. I don't know.
Well, I think that's fine. I think it's just it's a price value equation. I wouldn't buy one single family house in Kansas City, but if you gave me a package of 10, I might buy 10. And then when the comment is 100 times some current rent, well, what if half of them are empty? I don't know. I think there's more to it than that, but
yeah.
But we have syndicators I have a number of syndicators who on their own, have done 100 or 200 flips and now are doing funds where they're out buying 100 houses. And sometimes they do buy 10 in one location from someone else. And so I don't know about the valuation, but I think that's something. I actually do think the house flipping business is slowing down a little bit.
Mm-hmm.
I don't know if any of you watch television, Tariq El Moussa, the show Flip and Flop. I was called in there about 3 years ago, and he and his partner wanted to talk to me as they had people who were watching their TV show and would call them up and say, hey, can we invest in these houses with you? You buy them and then you fix them up and you make a profit. And his partner was the money partner. His partner had all the money, and Tariq and his wife at that time did all the renovation. And I said, well, that's advertising. So sure, you can do that. You could put it together and we could do an offering and find they walked away. And about 6 months ago, they came back to us. Actually, Jillian, my former partner, did an offering for them where they can take money from investors and team up with them to rehab houses. And that's a security. There's no doubt about it. And they're advertising. So you have to do a Reg D 506C. Fine.
Yep. Yeah, that's right. Zachary has another question here. What is the typical length of time that you would commit your funds in a syndication? I guess
Well, you have to read the document. Yeah. I don't think that's quite the answer. You're committing your funds until there's a capital event and you get them back. Yeah. Most syndicators will give you a range based on what's the maximum holding period of this property, given the lease and the loan and everything. What do they see? And today, I would say it's more common to have 3 to 7 years than anything else. But some projects are just longer. Some projects is going to take you 3 or 4 years to get the project built, rehabbed, developed, refinance, and then you get in a longer holding period. So the syndicator will have that plastered all over the documents, and you'll know. And that's a good question, because at my age, you're not going to sell me a 10-year deal. Too long. And other people who are even younger than I am, who are in a position where they have to take mandatory distributions from their IRA accounts, be careful about that. Don't take all the money from an investor and drain their IRA account when 3 years from now they have to start taking distributions and you have a 7-year holding period, you learn all that stuff from your subscription agreement and your offering questionnaire. Is the investor suitable for your investment?
Yeah, that's right. And part of it is that what are you really into? What do you really want to invest in? There's new development, there's multifamily, there's even single family syndications as well. I mean, they're all different, and each one of them will have their own typical length of time. But yeah, typically when we're putting deals together, we do, it'll typically be a 3 to 5 year refi and a 10-year sale. I mean, that's generally speaking, but I mean, I guess it depends on the deal though, right? We're working on a new development deal. We're working on the C-class asset. That's typically what it would be on a C-class asset for most people anyway. But it varies. It all varies. Part of it is your comfort level with the syndicator, with the area, with the property, with the returns, all of it as like one big thing. But generally speaking, 3 to 5 years refi or sell off in 10.
Right. And one of the things about that is if you're at a I'm going to try this for a second.
Yeah.
Okay. If you're at a reading a document and they're saying 7 to 10 year hold, and the loan balloons in 5 years, you better see what their plan is.
Right.
Because that just adds risk to project a holding period longer than the term of the loan. Because in my experience, and I've been doing this since 1979, the biggest change in our industry that creates downturns and upturns is the availability of financing. When financing goes away, everyone's in trouble because everyone who has a 7-year balloon can't refinance. I've done deals in terrible markets when there's no financing. I've done deals in, actually, who needs a syndication if you can borrow 105% of the purchase price?
Right.
Goes against what we said to start with, I do have enough money to buy all the real estate I want because the bank's going to lend me 105%. Okay. But if the bank's only going to lend you 60% and all the investors have 20% down, you're going to need 2 investors.
Yeah.
There's your syndication right there.
That's right. There you go. Let's see. Okay. Pavlo's asking, what is the main difference between syndications in red state versus blue states?
The font and the color of the ink in the private placement memorandums. There's no difference. There's no difference at all. There's nothing political about this at all.
Right. It all comes down to, again, your comfort level and the comfort level.
And if there was, I wouldn't comment.
Right.
That's
probably the better answer, right? Don't make it political.
But I will tell you that if I look back at the last 100 deals we did, there's a lot of deals in Texas, a lot of deals in Florida, a lot of deals in Arizona, a lot of deals in states where job growth.
Yeah.
Right?
Yeah.
Job growth. That's more important than red and blue.
Yeah. And they're also
when there's
landlord
new
friendly,
jobs,
right?
There's new household formations, and there's going to be demand for housing.
Yeah. And even landlord friendly states as well, or landlord friendly areas. Yeah. That's a big part of it too. In this market, this is Zachary asking, in this market, what kind of IRR can I expect from a syndicated deal?
You want to answer that?
I'll answer that. It really, again, depends on the deal, right? If it's a typical C-class type of asset, I'm usually targeting a 15% IRR, generally before all this COVID stuff.
Pre-tax.
Yeah, pre-tax. And that's what I target internally on my model. But whenever I'm like getting out there and then talking to accredited investors and getting them interested in a deal, I'll never say 15%. I'll probably say something along the lines of a 12, just in case we miss something. But this is actually a good question, just because there's a lot of people, especially starting off, I'll give you a 25% IRR. It's nonsense. Nonsense. It's hard to do. It's if not impossible, it's usually made up of it's untrue. There's no way. That's how you can easily tell someone who's very who just doesn't unsophisticated syndicator is what they are, right? But like I said, internally, when we're going through our numbers, I tend to be very, very conservative. I'm not one of those guys that will overpay for a deal. I'm not one of those guys that will say, oh yeah, 25% IRR, blah, blah, blah. It's just not what I do. I'm very, very conservative, and I want to set the expectation and blow it away. That's technically what I do. And it varies from syndicator to syndicator. They'll all tell you different things, right?
And that's a good answer.
Yeah.
That's a good answer. I was interested in hearing your answer, because across the board on properties that I think are not repositioning properties where a cash flow can be distributed, let's say at the end of 90 days, I think that the 12 to 15% IRR is saleable. If it's a repositioning asset and there isn't going to be any cash flow for a year or two, you might have to bump that up to 15 to 17, because people have to wait for their money. And I know there was a question, I saw the question, are there syndicators who pay monthly rather than quarterly? Yes, there are. That's a boondoggle for the syndicator. And depending upon how much money you invest, I'm not sure what you do with a monthly distribution check.
Yeah, I think it also depends on what it is that you're doing too. Like if we're doing a triple net lease, for instance, where that money is coming in consistently, then it might be possible to do a monthly return. But if you're trying to do like a typical syndication deal, listen, January is a bad month sometimes. Boiler breaks down. Guess what? It's going to have an impact on returns for that quarter. Right? It's very hard to predict. That's why that's another reason why some syndicators do their returns on a quarterly basis. Unless now if they're setting up as a fund, you get some more predictability, and then you're able to do something a little more frequent. But it all depends on the size and scope and how it's set up. Right? Whether it's a C-class asset, it's a fund of C-class assets. If it's a fund like what Grant Cardone does, he does these A-class type scenarios, somewhat predictable. That's why they also have very low cap rates, but he also delivers his returns month over month, right? He can do that.
I would just make a comment, and this isn't toward the person who asked the question. This is a general comment relating to the industry of investing in a syndication. If you're going to invest in a syndication and you're going to need the monthly cash flow to buy groceries, don't do that.
Yeah, don't do that.
You're not suitable to invest in a syndication. These are illiquid, risky investments. This wouldn't be the first investment I'd make. I'd have a house, I'd have some life insurance, I'd have some savings or some mutual funds, something like that that's liquid. And then with some of the money I have that I could play long-term with, and really not even worry about the revenue. I want to protect my principal, and hopefully my principal will grow. Then I might go into a syndication.
Yep, that's right. I mean, there's some deals like triple net that are better than others, but again, there's still risk involved with that. But that's a whole other discussion. So Yuri's asking, Augustino or Gene, how often do your deals involve some kind of rehab?
50% of the time.
Yeah. And in our case, I'm always trying to find a value add type scenario where I'm able to go in, improve the property, turn up the rents, and create a better environment for the people living there, and also bump up the returns and hand it back to the investors. That's the kind of thing I'm looking for, a win-win in that scenario. So there are scenarios, of course, where we're doing like a complete rehab, like a deal that we're working on right now with Gene here. And that's a monster deal, killer deal. It's huge. We don't do those very often. But Gene, I already have my eyes on the second one. It's coming. Got another one coming. So we'll see. But generally speaking, value add deals is what we're targeting. Room for us to make some improvements and crank up the rents. So, and then we got another one here from Pavlo. He says, what's the aspect of syndication of deals that can be impacted the most by the aftermath of the pandemic?
Well, rent collection.
Yeah.
Rent collection. I think the biggest risk in the real estate spectrum has got to be retail and office. Retail businesses, they talk about how many small businesses are going to go out of business, how many small retail shops are going to be vacant. In office buildings, there's two sides. People say, well, only, we're not going to need as big of an office space anymore because only half as many people are going to go to work in the office. And I said, yeah, but they're spread out twice as far. So with social distancing, you have to have the same amount of space to put up with half of the people. I'm kind of cynical on that, but I think there's an argument there. And so I would think office and retail would be the worst. And I read a lot of stuff about this, but the rent collection over the last 3 months in the multifamily industry is really close to 90%.
Yeah.
So whatever. I hate to do this to you, but it's 4:30 my time. It's 6:30 your time. Your people are looking for mandatory margarita time or something. I would think they'd have enough about this old guy sitting here.
I don't know. I think so too, guys. I'll tell you what, though. If you guys have any questions, feel free to put them in the chat. And then what we'll do is, I know there's one here from Yuri. How do you typically acquire the financing for rehab costs? Does that tend to come out of the investors on top of the down payment? Yes, generally speaking, that's generally how we do it. It's included as part of your acquisition costs.
Nancy's got the best question of all.
Yes.
Are you sending margaritas our way?
Well, hey, listen, guys. We're going to be doing some live events here in Cleveland coming up here soon. So maybe Gene will make it out. I hope. Maybe we'll see. We'll see.
Oh,
I know
maybe
he loves
that
a
would
rock
be
and roll Hall of
fun.
Fame. Yeah.
We do.
Hi, this is Nancy. Can I just ask a quick question? I know you guys were going to have an event in California in June. Is that postponed?
Are you doing an event, Gene?
No. Disrupt Equity up in San Francisco in June has been postponed. It was postponed. It's already July. It was postponed.
Right. But I just couldn't find any information about it. And when I saw Kenny and Agostino in Manhattan a few months back, Kenny had mentioned that it was supposed to be, I think, June 12th.
I think the next one, right, I was going to speak at that, but I think the next one that they have on schedule is Boston in October, and who knows. Nancy, everything I've been scheduled to speak at live up to and including running the half marathon in Kauai on September 6th has been postponed.
Well, maybe you want to come and run the New York Marathon in November if it's.
That was postponed yesterday.
Oh, was it? Okay.
Mm-hmm. So anyhow, I will tell you something, Augustine. Then I got to go. But our company, our firm, once a month has mandatory Margarita Tuesdays. We get together online. We Zoom at 5:00 out here on Tuesday night, and we all have a margarita. And my firm is very virtual. We have people in San Diego, San Francisco, Nashville, LA, and Orange County. And so 5:00 we do that, and it's pretty wild.
I think that sounds like a future event right there.
Very
we
good.
We just do one of those.
Thanks for having me.
Yeah, thanks for coming on. Everyone, thanks for coming on too. We're going to have this thing on YouTube probably in the next 24 to 48 hours. So if you want to go back and reminisce about the great times we've had here tonight, you'll be able to check it out. I'll send out a notification to everyone that's on here. Okay.
And you'll send out how they can get a hold of me at Gene@TrowbridgeLawGroup.com.
Yep, that's right. That's right.
Okay.
I'll put Gene's email in the description too. So, all right, guys, thank you so much. Take care. Okay.
Bye.
Bye, guys.